Shanghai just closed silver at $100, while the West is still trading at $90. That's a $14 premium gap, the biggest we've seen in months. But here's what they're not telling you. The gold-silver ratio just crashed below a critical level, and in exactly 48 hours. Something's about to happen at the COMEX that could change everything. 87 million ounces registered, 115 million ounces in open interest. You do the math, the shorts are trapped, the premiums are exploding, and the countdown has already begun. What happens when the music stops? Welcome, my friends, to Currency Archive. You know, I've been doing this for decades now, and I've learned that the smartest people in the room are the ones who pay attention to what others ignore. If you've been around as long as I have, you understand that knowledge is the real currency. So do me a favor, would you? Hit that subscribe button. Not because I'm asking, but because you know this information could be worth its weight in, well, silver. And tell me, where in the world are you watching this from today? Drop your city or country in the comments. I'd love to know where my fellow truth seekers are tuning in from. Now, let's talk about what's really happening. A trader in Shanghai looks at his screen and sees silver closing at $104 per ounce. At the exact same moment, a trader in New York watches silver trade at $90. The same metal, the same global market, but a $14 difference in price. This is not supposed to happen. In normal market conditions, such a gap would last minutes, perhaps hours at most. Arbitrage traders would immediately buy silver in the cheaper market and sell it in the expensive one, pocketing the difference and closing the gap. This mechanism has kept global commodity prices aligned for decades, but something has broken. The premium that Shanghai is paying over Western markets has now reached $10 to $14 per ounce. To understand how unusual this is, one must look at historical data. Over the past 10 years, the typical premium between Eastern and Western silver markets ranged between $0.50 and $2 per ounce. Occasionally, during periods of high demand in Asia, this premium would spike to $3 or even $5. But $14 represents a 15% premium over the Western price. This is not a minor fluctuation. This is a structural dislocation. The question every serious analyst is now asking is simple. Why is arbitrage not working? Silver is a fungible commodity. An ounce of silver in London is identical to an ounce of silver in Shanghai. Transportation costs, insurance, and logistics typically add no more than $1 to $2 per ounce when moving metal between continents. Even accounting for these costs, a trader should be able to buy silver in New York at $90, ship it to Shanghai, and sell it at $104, making a clear profit. Yet this is not happening at the scale needed to close the gap. The reason reveals something critical about the current state of the physical silver market. There is not enough readily available physical silver in the West to meet Eastern demand at current prices. When markets for physical goods show persistent price differences across regions, it signals one of two things. Either transportation has become impossible, or supply in the cheaper region is constrained. Since there are no shipping embargoes or logistical breakdowns preventing silver movement, the answer must be the latter. Western silver inventories are not flowing east in sufficient quantities to equalize prices. This tells observers that the pool of available silver in Western markets, the silver that can actually be purchased and delivered quickly, is smaller than what surface-level inventory numbers might suggest. To put this in perspective, consider what happened during previous commodity market dislocations. In 2020, when COVID-19 disrupted supply chains, gold briefly traded at premiums of $60 to $100 over spot prices in retail markets. But that was a temporary logistics crisis. Within months, as shipping normalized, premiums collapsed. The silver premium between East and West has now persisted for weeks and is expanding, not contracting. Analysts who track the Shanghai Futures Exchange have noted another troubling detail. The premium exists not just in spot prices, but also in futures contracts. Shanghai silver futures for March delivery closed at $104, while COMEX futures for the same month trade at $90. Futures prices reflect expectations about future supply and demand. When futures in one market consistently trade at significant premiums to another, it means market participants in that region expect tight supply conditions to continue. Chinese buyers are essentially saying, we believe silver will remain scarce enough in our market that paying $104 today is justified. Western markets, meanwhile, are pricing in more readily available supply at $90. One of these markets is wrong. Either Western silver is about to flow east in massive quantities and close the gap, or Western prices are about to rise to meet Eastern levels as the reality of limited supply becomes undeniable. History suggests the second outcome is more likely. During the silver crisis of 1980, when the Hunt brothers attempted to corner the market, premiums and dislocations emerged before the price spike became obvious to the general public. By the time retail investors noticed something unusual was happening, silver had already moved from $6 to $35. In 2011, when silver rallied from $18 to $40, early warning signs appeared months before in the form of persistent backwardation in futures markets and unusual premium behavior in Asian markets. The current $14 premium between Shanghai and the West is not just a number on a screen. It is a warning signal. It tells serious observers that the mechanisms which normally keep global silver prices aligned are under severe stress. It suggests that physical silver available for immediate delivery is becoming increasingly difficult to source in the quantities demanded. And it raises an uncomfortable question for anyone holding paper silver contracts in Western markets. When settlement day arrives, will there be enough physical metal to meet delivery obligations? The answer to that question is becoming clearer with each passing day, and the implications are significant. Inside the vaults of the COMEX exchange, 87.2 million ounces of registered silver sit waiting. On paper, 115 million ounces are owed to contract holders demanding delivery. The math is simple and troubling. March settlement arrives in 48 hours. For those unfamiliar with commodity futures markets, settlement is the moment when paper promises must transform into physical metal. Contract holders who purchased silver futures can either roll their positions forward to a later month or stand for delivery, demanding actual bars of silver be transferred to their accounts. In a functioning market, this process unfolds smoothly. Most traders roll their positions. A small percentage takes delivery. The exchange ensures adequate metal exists to satisfy those demanding physical settlement. But March 2025 is revealing cracks in this machinery. Yesterday, 71 million ounces rolled from March contracts into later months. This represents the largest single-day roll in recent COMEX history. To understand why this matters, one must grasp what a roll of this magnitude signifies. When traders roll contracts rather than take delivery, they are making a choice. They are saying, I prefer to maintain exposure to silver price movements, but I do not need physical metal right now. Under normal circumstances, rolling is routine. Speculators and hedge funds rarely want actual silver bars. They trade for profit, not possession. But the scale of yesterday's roll suggests something else was happening. Traders who might have considered taking delivery chose not to. The question becomes, was this choice voluntary, or were they encouraged to roll by exchange officials concerned about delivery capacity? The COMEX has a history of managing settlement stress through persuasion. In previous tight markets, phone calls are made, incentives are offered. Large holders are quietly asked to roll positions rather than demand metal. No official statements confirm this happened yesterday, but the numbers speak clearly. 71 million ounces represents approximately 61% of total March open interest, rolling in a single day. Historical data shows typical daily roll volumes rarely exceed 30 to 40 million ounces. When rolls spike to these levels, it indicates coordinated movement, not organic market behavior. Here is where the story takes an unexpected turn. During yesterday's massive roll, silver prices did not decline. They rose. This defies conventional market logic. When large volumes of contracts are rolled or closed, it typically reduces immediate buying pressure. Prices soften. Yet silver climbed from $87 to $91 during the very hours when 71 million ounces were being rolled forward. What does this tell careful observers? It reveals that demand for physical silver at current price levels remains robust despite the roll. New buying entered the market simultaneously, absorbing the rolled positions and pushing prices higher. This suggests the underlying bid for silver is stronger than surface-level contract data indicates, but the core vulnerability remains unresolved. After yesterday's roll, 115 million ounces of open interest still exists heading into settlement. Against this, only 87.2 million ounces of registered silver, metal available for immediate delivery, sits in COMEX vaults. The deficit is 27.8 million ounces. Now, some will argue this deficit is not alarming. They will point out that not all contract holders demand delivery. They will note that additional metal can be shifted from eligible to registered status if needed. They will suggest that previous months have seen similar imbalances resolve without crisis. All of this is technically true, but it misses the larger pattern. COMEX registered silver inventories have been declining for months. In January 2024, registered silver stood above 120 million ounces. By mid-2024, it had fallen to 95 million. Now it sits at 87.2 million. Each month, metal leaves the system, and critically, new metal is not flowing in to replace it. Analysts tracking daily warehouse reports note an absence of fresh silver deposits. Normally, when prices rise, mining companies and recyclers are incentivized to deliver more metal to exchanges. Higher prices should attract new supply. This is not happening. The lack of new inflows suggests two possibilities. Either holders of physical silver believe prices will rise further and are withholding metal from the market, or available above-ground silver is already committed elsewhere and cannot easily be redirected to COMEX. Both scenarios point toward the same conclusion. Available silver is tighter than official inventory numbers suggest. 1 month ago, concerns about a March force majeure circulated through precious metals forums and trading desks. Force majeure is the nuclear option in commodity markets, a declaration by an exchange that it cannot meet delivery obligations due to circumstances beyond its control. If COMEX had declared force majeure, it would have meant contract holders demanding silver could not receive it. Instead, they would be offered cash settlement at prices determined by the exchange, not by the market. Such an event would shatter confidence in paper silver markets. Today, force majeure concerns have subsided. The massive roll yesterday relieved immediate pressure. March settlement will likely proceed without formal default. But the temporary relief obscures the deeper problem. The metal that rolled yesterday did not disappear. It moved to May, July, and later months. Those contracts will eventually reach settlement. And unless new silver flows into COMEX warehouses, the same shortage will resurface. This is not a March problem. This is a structural problem. Every month, the exchange must navigate the gap between paper claims and physical metal. Every month, the ratio between open interest and registered inventory grows more precarious. Every month, the probability increases that one settlement cycle will expose the system's limitations. Traders watching these dynamics understand what is unfolding. The COMEX is managing a slow-motion inventory drain. Prices are rising not because of speculation, but because physical metal is genuinely difficult to source in the quantities demanded. And when inventories fall below critical thresholds, price discovery shifts from paper markets to physical markets. That shift has already begun. For centuries, traders have watched the relationship between gold and silver. How many ounces of silver does it take to buy 1 ounce of gold? This number, known as the gold-silver ratio, has just broken through a critical technical threshold. And the implications extend far beyond simple chart patterns. The ratio now sits below its 50-day moving average. For those unfamiliar with technical analysis, a moving average represents the average price over a specific period. When an asset breaks below or above its moving average, it often signals a shift in momentum. But the gold-silver ratio is not an asset. It is a relationship. And when relationships between monetary metals shift, they reveal changes in how markets perceive value, scarcity, and risk. Gold currently trades at approximately $2,850 per ounce. Silver trades at $90. Dividing gold by silver gives a ratio of roughly 31.6 to 1. This means it takes 31.6 ounces of silver to equal the value of 1 ounce of gold. Historically, this ratio has fluctuated wildly. During the 1980 silver spike, it fell to 15 to 1. In 2011, it reached 32 to 1 during silver's rally to $49. In March 2020, during the COVID panic, it exploded to 125 to 1 as silver was dumped while gold was hoarded. Over the past century, the long-term average has hovered between 50 to 1 and 60 to 1. Currently, the ratio is compressing. Silver is gaining value relative to gold at an accelerating pace. The 50-day moving average that was just broken represented a line that had provided resistance for weeks. Each time the ratio approached this level, it bounced back upward, meaning silver weakened relative to gold. But 2 days ago, that pattern broke. The ratio sliced through the 50-day moving average and continued falling. This technical breakdown coincided precisely with silver's price surge from $87 to $91. Coincidence is rare in financial markets. When technical signals align with fundamental developments, they create what traders call confluence, multiple independent factors pointing in the same direction. The question analysts are now asking is whether this ratio compression will continue. To answer this, one must understand what drives the gold-silver ratio in the first place. Gold is primarily a monetary metal. Central banks hold it. Investors buy it as a store of value. Industrial demand for gold is relatively small. Its price reflects confidence in currency systems, inflation expectations, and geopolitical stability. Silver is different. It serves dual roles. It functions as a monetary metal like gold, but it is also an industrial commodity. Electronics, solar panels, medical equipment, and hundreds of other applications consume vast quantities of silver annually. This dual nature creates unique dynamics. When economic growth accelerates, industrial demand for silver rises. When monetary instability emerges, investment demand for silver increases. When both happen simultaneously, silver faces supply pressure from 2 directions. Recent data suggests both forces are active. Industrial consumption of silver has reached record levels. The solar industry alone now consumes over 150 million ounces annually. Electric vehicles require significantly more silver than traditional combustion engines. The global push toward green energy infrastructure is structurally bullish for silver demand. Simultaneously, geopolitical tensions and currency debasement concerns are driving investors toward precious metals. But while gold receives most of the attention, silver offers a compelling alternative. At current prices, silver remains 50% below its 1980 inflation-adjusted high. Gold, by contrast, has exceeded its historical peaks. For investors seeking undervalued monetary metals, silver presents a more asymmetric opportunity. This combination, rising industrial consumption and increasing investment demand, creates a supply-demand imbalance that the gold-silver ratio is beginning to reflect. Now, technical analysts are watching specific price levels on silver itself. For several days, silver encountered resistance between $87.20 and $89. Each attempt to break above this zone was met with selling pressure. The metal would rally to $88 or $89, then fall back to $85 or $86. This created a clear resistance zone that traders could identify and monitor. On Tuesday, silver finally broke through. It closed an hourly candle above $89, signaling that resistance had been overcome. The price then accelerated to $91 before pulling back slightly to $90. In technical analysis, when a resistance level is broken, it often transforms into support. The logic is simple. Traders who were selling at $87 to $89 because they believed that was the ceiling now recognize they were wrong. If price returns to that zone, they become buyers instead of sellers, creating a floor. This is exactly what appears to be happening. Silver tested $90 after its spike to $91 and held. The former resistance zone between $87 and $89 is now acting as support. The next technical target, according to chart watchers, is $92. But numbers on charts only matter if they align with fundamental reality. And here is where the story becomes compelling. The technical breakout in silver is not occurring in isolation. It is happening as COMEX inventories fall, as Shanghai premiums widen, and as the gold-silver ratio compresses below key moving averages. Each of these factors is independent, yet all are pointing in the same direction. This is what confluence looks like in real time. Technical traders see resistance breaking and momentum building. Fundamental analysts see supply constraints tightening and demand accelerating. Macro observers see a geopolitical instability and monetary uncertainty favoring hard assets. When technical and fundamental signals align, major price moves often follow. History provides context. In late 2010, silver was trading around $18 per ounce. The gold-silver ratio was above 60 to 1. Industrial demand was rising as the global economy recovered from the 2008 financial crisis. Investment demand was building as central banks launched unprecedented monetary stimulus. Over the following 6 months, silver rallied to $49. The gold-silver ratio fell to 32 to 1. The current setup shows striking similarities. Industrial demand is at record levels. Central bank balance sheets remain historically bloated. Inflation concerns persist despite official narratives. And critically, physical silver inventories are declining while paper claims are expanding. The gold-silver ratio breaking below its 50-day moving average is not just a technical event. It is confirmation that market forces are shifting. Silver is beginning to outperform gold, not because of speculation, but because supply-demand fundamentals are asserting themselves. Traders who understand this are positioning accordingly. They are watching the $92 level on silver. They are monitoring whether the ratio continues to compress. They are tracking COMEX inventory data for signs that physical tightness is worsening. And they are recognizing that when multiple independent indicators converge, the market is often preparing for a significant move. The technical structure is in place. The fundamental backdrop is supportive. The ratio is confirming the trend. What happens next will depend on whether physical supply can meet accelerating demand. Current evidence suggests it cannot. Markets do not move randomly. They respond to imbalances between supply and demand. And right now, the silver market is revealing an imbalance that cannot be ignored. The core thesis driving silver prices higher through 2025 and into 2026 is straightforward. Physical demand is exceeding available supply. This is not speculation. It is observable in the data. COMEX registered inventories have fallen from 120 million ounces to 87.2 million ounces over the past year. During that same period, industrial consumption has increased, investment demand has risen, and new mine supply has remained flat. Every month, more silver leaves the system than enters it. This trend, if it continues, will force a repricing of silver, not because of hype or momentum trading, but because the physical metal required to satisfy demand simply will not exist at current prices. Analysts tracking this situation are monitoring one metric above all others: the amount of registered silver backing COMEX futures contracts. This number has become the single most important indicator for forecasting silver's trajectory. When registered silver was above 100 million ounces, the market had breathing room. Shortages were theoretical. Settlement stress was manageable. Now, with registered silver below 90 million ounces and falling, each settlement cycle becomes more precarious. The next critical data point to watch is the futures spread between contract months. Currently, March contracts are in contango relative to May contracts. Contango means future months trade at higher prices than near months. This is normal in commodity markets and reflects storage costs, interest rates, and carrying charges. But when physical supply becomes genuinely tight, futures markets flip into backwardation. Backwardation means near-term contracts trade at higher prices than future contracts. It signals that buyers need metal now and are willing to pay a premium for immediate delivery. In the silver market, backwardation has historically preceded major price rallies. When the March-May spread flips from contango to backwardation, it will confirm that physical tightness has reached critical levels. Traders watching this spread are waiting for that signal, and when it comes, they expect COMEX outflows to accelerate dramatically. Here's how the sequence is expected to unfold. First, spreads flip into backwardation as demand for immediate delivery intensifies. This attracts arbitrage traders who buy spot silver and sell futures, locking in profits. To execute this trade, they must withdraw physical silver from COMEX warehouses. Second, as metal leaves COMEX, registered inventories fall further. Lower inventories increase settlement risk, which pushes more traders to demand physical delivery rather than trust paper contracts. Third, retail investors begin noticing that silver is consistently rising. Media coverage increases. Mainstream financial outlets start discussing silver as an investment opportunity. Fourth, retail capital flows into silver ETFs. These exchange-traded funds must purchase physical silver to back their shares. Each $1 billion flowing into silver ETFs removes millions of ounces from available supply. Fifth, as ETF demand compounds with industrial demand and investment demand, the gap between available supply and total demand widens further. Prices rise not in a straight line, but in surges as each new wave of buyers enters the market. This is not a prediction. This is a description of how supply-demand imbalances resolve themselves in commodity markets. The timeline for this sequence depends on how quickly registered silver continues to decline. If outflows continue at the current pace of 3 to 5 million ounces per month, registered inventories could fall below 70 million ounces by mid-2025. At that level, the ratio between open interest and available metal becomes critically unstable. If backwardation emerges in the May-July spread, outflows could accelerate to 10 million ounces per month or more. Under that scenario, registered inventories could approach 50 million ounces by late summer. At 50 million ounces, COMEX would be operating with less than half the inventory it held just 18 months ago. Settlement stress would become chronic rather than episodic. This raises a question for businesses and investors. How should one position for this environment? For companies that consume silver in their operations, electronics manufacturers, solar panel producers, medical device companies, the strategic imperative is clear. Lock in supply contracts now. Prices at $90 per ounce may seem elevated compared to the $22 silver traded at in 2020. But if the supply-demand thesis plays out, $90 will appear cheap in hindsight. Delaying procurement in hopes of lower prices is a risk. If physical tightness worsens, suppliers may struggle to deliver contracted volumes regardless of price. Securing supply chains becomes more important than optimizing purchase prices. For investors, the opportunity lies in recognizing that silver's current price does not yet reflect the full extent of the supply deficit. Markets are slow to adjust to structural changes. Price discovery takes time. Institutions move cautiously. Retail investors react with a lag. But the data is already clear. Supply is constrained, demand is rising, inventories are falling. Those who position ahead of broader market recognition stand to benefit significantly. The risk, of course, is that new supply emerges. Perhaps mining companies ramp production in response to higher prices. Perhaps recycling increases as old electronics and industrial equipment are processed for their silver content. Perhaps central banks or governments release stockpiled metal onto the market. All of these are possible, but none appear likely in the near term. Mining production is constrained by geology, permitting timelines and capital investment cycles. It takes years to bring new mines online. Existing mines are already operating near capacity. Recycling does increase with higher prices, but recycled silver only accounts for about 15% of annual supply. Even a significant increase in recycling would not offset the growing deficit. Government stockpiles are opaque, but historical patterns suggest official silver reserves are far smaller than commonly believed. The United States government, for example, holds negligible silver inventories compared to its gold reserves. This means the supply response to higher prices will be muted and delayed. Demand, meanwhile, shows no signs of slowing. The global transition to renewable energy requires massive amounts of silver. Electric vehicle adoption is accelerating. Investors in emerging markets are increasingly turning to precious metals as currency instability persists. The collision between constrained supply and rising demand is not theoretical. It is happening now. The Shanghai premium is evidence. The COMEX inventory decline is evidence. The gold-silver ratio breakdown is evidence. Each data point viewed in isolation might be dismissed as noise, but together they form a coherent picture. Silver is repricing. The process has already begun. For business leaders, this means supply chain decisions made today will determine operational continuity tomorrow. For investors, it means recognizing that the market has not yet fully absorbed the magnitude of the supply-demand imbalance. And for analysts watching these developments, it means understanding that this is not a short-term trade. This is a structural shift. The window for proactive positioning is narrowing. As more participants recognize what is unfolding, prices will adjust rapidly. The opportunity exists for those who act on data rather than waiting for consensus. The silver market is sending clear signals. The question is whether decision makers are listening. The countdown has already begun.